Hello everyone. In this video, I will review what I believe historical bond yields tell us about the relationship between risk premium and the treasury rate for bonds with differing credit risk, as determined by credit ratings. Let's take a very simple example. Let's say I have a portfolio of fixed income securities with an overall weighted duration of 7. I assume that rates will continue to rise. Therefore, I want to reduce my portfolio's duration. In effect, I want to reduce duration so that interest rate hikes don't affect my portfolio's value as much. Now you might think that the answer here is straightforward. Replace the low-yielding bonds with high-yielding ones, typically of a lower credit rating, and reduce the portfolio's duration that way. I still believe that is the correct overarching strategy, but that the execution of said strategy is more complicated due to how high-yield bonds interact with interest rates. In academia, this is referred to as the difference between analytical and empirical duration, or the difference between duration that is calculated based off forecasted cash flows and the interest rate sensitivity as exhibited by the markets. To start off, I pulled 3 columns of data from the St. Louis Fed. First are the par yields of the 20-year Treasury. Second, the yields of the Moody's AAA Corporate Bond Index, and third, the yields from the Moody's B Corporate Bond Index. I also pulled the cumulative gains of the S&P 500 over the same time period and calculated the spread between the 20-year Treasury and the AAA Index and the 20-year Treasury and the B Index. When I set out to investigate the relationship between bond yields, risk premiums, and treasuries, I had the option to use 2 different bonds with a high credit rating and another with a low credit rating. However, I chose to use the Moody's index because I figured it would prevent any issues due to illiquidity in the corporate bond market and also prevent any kind of idiosyncratic effects from seeping into the analysis. Both the AAA and B indexes are comprised of bonds with 20-year maturities. Now looking at the first graph here on the right, we see a familiar story. In the blue here is the 20-year Treasury yields. Above the 20-year Treasury is the AAA index, with typically a 100 basis point spread above the 20-year Treasury. Then above the Moody's AAA index is the Moody's B index, with typically around a 200 basis point spread above the 20-year Treasury. Now you would think that the AAA and the B indexes would move in the same direction. That is, the 20-year might increase by 50 basis points, with the AAA and B indexes increasing by 50 basis points as well. Effectively, they should track the Treasury plus a risk premium. The spread should be consistent. But, as you can see from the graph of the AAA and B index spreads, while the spread of the AAA index is fairly stable, as expected, the spread for the B index jumps all over the place. Now, the graphs can help orient analysis, but they aren't analysis in of themselves. So I used Excel to analyze the AAA and B indexes with a regression analysis. Now, I will say that the point of this regression is not to forecast future yields. Instead, I'm conducting this regression analysis to determine what correlation the bond indexes have with their respective Treasury index. You can see that for the AAA index, the 20-year yields can explain 85% of the variance in the AAA yields. That's a fairly good indicator. But for the B index, the 20-year yields only explain 63% of the variance. So clearly, the AAA index is very sensitive to interest rates, but the B index is less sensitive than the AAA index. With 63% of variance explained, I'm likely missing other variables which would explain the variance. But let's remember that corporate bonds are not only sensitive to interest rate risk, but also corporate credit risk. The B index bonds have poorer fundamentals than the AAA bonds and are therefore more sensitive to credit risk. To wrap things up, let's consider what might be happening in 2020 here. In early 2020, the markets were rocked by the coronavirus. The result is that the Federal Reserve cut interest rates, which you can see happening up here, rates decreased dramatically in early 2020. In addition, you can see that spreads for the B index skyrocketed. Investors believed that the economy was going to take a hammering and sold off riskier bonds in a flight to quality. In this case, investors were weighing default and credit risk much more than they were weighing interest rate risk for those B-rated bonds. And so the B-rated bonds act like a mix of standard bond models and equities. We can see that relationship here. As the stock market crashed, yields jump. And as the stock market began to recover, yields began to settle again. That's a reflection of investors selling and buying those riskier bonds. That's a reflection of how they believe the underlying fundamentals of the companies are going to perform. And once again, here, when the stock market began to catch some heat due to rising rates and likely recession, the spread between the B and the AAA bond indexes widened. Finally, I ran another regression analysis. Now, I'm not using a lot of data here, but you can see that with the addition of the S&P data, the regression model now explains 75% of variance, up from 63% without the S&P data. So to go back to the initial question of trying to reduce the duration of a portfolio. If I was the portfolio manager and I were trying to solve for Macaulay duration, I would find an analytical duration which is greater than empirical duration for these B-rated bonds. In effect, the less creditworthy bonds are less sensitive to interest rates than Macaulay duration would imply. If I only applied Macaulay duration, I would be over-hedging for interest rate risk without considering the hybrid nature of lower credit fixed income products. Thanks for watching, and I hope you found this video to be informative.